Recession fears have been hanging over the markets for quite some time now. But what is corporate America telling us about the state of the global economy? Joining us now to discuss, Damian Fernandes, portfolio manager at TD Asset Management. Damian, great to have you back on the show.
Thanks, Greg. Great to be on.
So we've been talking of recession, fear of recession on the horizon for a long time now, and yet we're in the thick of another earnings season. In terms of corporations, what are they telling us about what they're going through and what might be ahead?
Well, they're telling you things are slowing. But interestingly, things are slowing less than people are forecasting. When you look at just the breadth of earnings season, and by the way, we're basically done earnings season. The only companies left are the retailers who have a month lag. So about 440 companies in the S&P have reported. It's about 90% of market cap. And while earnings are negative, they're less negative than people were expecting. And I can put some numbers into that, right? People were expecting, close to high single digit, like negative 9% earnings growth. It's coming in at negative, 3, 4. So materially much better. And the top line's still growing because inflation's still growing. So that helps support the top line. So on balance, what you're finding is that this earnings season is actually surprising in how less bad it is. Which I think it gives you a sign, right? Just your opening comments were, when is this recession coming? Like, when is this?
We've been signposting for quite a while now.
I think people just have to think about a conventional recession, and muscle memory forces people to think about the most traumatic experiences. The most traumatic recessions we just had, the COVID recession or the '08 recession. Don't think of that. This is a much more conventional recession. Think '91, think 2001, where some parts of the economy will slow, and some parts of the economy will, just tether along and provide some, some impetus for growth.
In terms of what companies are telling us about what they expect going forward, I recall among some of the big tech names that said, well, we're seeing slowing demand of customers from our, some of our cloud services, other areas as well. It seems like they're preparing for it, but are they overly dire, or is this sort of what we'd expect, run of the mill?
Well, just, we can take about, so year to date, what's been leading the market? I'm sure in other shows you've talked about this, right? The FANG stocks, right? Like FANG bites back. But interestingly, those stocks, those secular growers, are actually showing the best earnings delivery, right? We had Microsoft on the day it reported earnings was up 7, but Microsoft is calling for, up to 9% constant currency revenue growth, double-digit EPS growth. Facebook was a surprise. Facebook. I still remember the old ticker.
I still call it Facebook.
I know.
It's
So if we talk about muscle memory, it's etched into my head. But Meta reported it's calling for revenues to be up high single digits next quarter. That's much better than people feared with a pullback in advertising. So I think that broadly, parts of the market are growing nicely or are delivering earnings that are a little better than expectations, and there's some parts that are lagging.
What are the markets really waiting for, I guess, in terms of a direction? We've had the recession fears for the longest time. We've got a U.S. Federal Reserve that might be on pause. I mean, they're not using that word, but the street seems to be thinking, well, maybe they're done, or maybe there's one more. I mean, what is the catalyst going forward?
The catalyst, I think what's surprising people is, why isn't the market lower? Right? That's, front and center. We were talking about earnings. We've been talking about it for a while. Actual company earnings are negative year on year. They're better, but they're still negative. And I think what people, or at least my view, is that the reason the market is where it is and hasn't, fallen out of bed is because think about last year and what caused your viewers' indigestion. Right? What caused you to reach for the Pepto-Bismol? It was 4 things, really, right? It was accelerating inflation. It was Federal Reserves that were tightening rates aggressively to address that inflation genie out of the bottle. We still do, but there was a war that lit a fuse under commodity prices that exacerbated those inflation worries. And then finally, the world's second largest economy was still in a zero COVID policy in China. As we look forward today, and the start of this year too, a lot of those, 3.5 of those 4 things, like sadly, tragically, there's still a geopolitical conflict, but every commodity price from WTI to potash to iron ore is lower year on year. The second largest economy is now accelerating as it wakes up from its COVID hangover, and inflation is falling. It's falling. Maybe it doesn't get to the Fed's target of 2%, but it is falling, and so that kind of puts the Fed out of the game, right? Your initial comment. So I think these big, there's things to worry about. Look, I'm not This isn't all, like blue skies ahead. We do have some worries, but the main agitators of last year's market performance actually look to be receding.
Markets, we are told, are forward-looking instruments, so are they looking past perhaps a mild recession, a soft landing, whatever people are thinking it's going to be, and looking to the other side of it?
Yeah, I think that is the pivotal question. Right now, I was talking about, it's still not, sunny skies, blue skies ahead. It's because we're not sure about the magnitude of this drawdown. What I mean by this drawdown, I mean this economic pullback. Look, we might be going to recession, we might be going to soft landing. I think the market is pricing in a scenario where we're going into a softish landing, a shallow recession, where we can recoup last year's earnings by sometime next year. If what's happening with credit tightening in the U.S., or if something comes out of left field, if we have a much more traumatic pullback, then the market, that's what the market would get it off its skis, would cause concern. Well, we're following these things. Something else that I'm looking at is that's giving me a source of grief is probably debt ceiling negotiations that are down the pipeline. All of these things can take a regular slowdown or a run-of-the-mill pullback, shallow recession, and it can metastasize into something much more deeper. And then that's when the market falls out of bed again.
We've been Fed watchers, obviously central bank watchers for the past year for a very good reason. As you said, this very aggressive rate hiking campaign. It seems that there's parts of the market, I'm probably thinking more like fixed income in the bond market, that thinks that they're going to be turning pretty quickly from being very aggressive in terms of tightening policy to suddenly slashing rates. How does that actually line up with reality, do you think?
Look, well, I try and think about historical precedents, and historical precedents being, and not being a fixed income expert, but just being able to weigh on this, is that the Fed normally tightens till something breaks. Well, guess what? They broke 3 regional banks and a global investment bank in this tightening campaign. Historically, when you think about what's happened, is that after you've had a tightening campaign has led to a financial crisis of sorts, the Fed is on pause. And I think that playbook probably applies. In terms of Fed cuts this year, we'll just have to see if the data plays out. If the economic data continues to show up like the earnings data, which is not as bad as feared, maybe some of those cuts have to be walked back. Or maybe not if the economic situation continues to slow. But in general, I think the initial part of your comment, the fact that the Fed being on pause or on hold with the potential for cuts, I think that's very likely.